You never voted for it. You rarely hear its name. And yet, it quietly decides how expensive your life will be. Your rent, your loans, your business, your future. All of it bends around one invisible force: interest rates. And here's the unsettling part. They're not just set by one person, one country, or even one decision. They're shaped by a system, a global, interconnected system. And right now, it's under pressure. Let's start simple. What is an interest rate? At its core, it's the price of money, the cost you pay to borrow or the reward you get for saving. But that price doesn't just appear. Step one, central banks. Every major economy has one. The Federal Reserve, the European Central Bank, others. They set a base rate. Think of it as the anchor for all borrowing. When they raise rates, borrowing becomes more expensive. When they cut rates, money becomes cheaper. Sounds straightforward, but here's where it gets interesting. Central banks don't just pick numbers randomly. They're reacting, constantly, to inflation, to unemployment, to growth. If inflation rises too fast, they increase rates to slow spending. If the economy weakens, they cut rates to stimulate borrowing. So already, interest rates are not fixed. They're a response to economic pressure. But that's only the first layer. Step two, markets. Even if a central bank sets a base rate, the real world doesn't fully obey it. Investors, banks, funds, institutions are constantly buying and selling debt. Government bonds, corporate loans. And these investors are asking one question: how risky is this? If risk feels high, they demand higher returns, which means higher interest rates. If risk feels low, they accept lower returns. So now, interest rates are no longer just controlled by policy, they're shaped by perception. Fear, confidence, uncertainty, all moving in real time. Now, step three, the global connection. Here's where it becomes invisible and powerful. Money doesn't stay in one country. It moves fast. If interest rates rise in one major economy, investors shift their money there to earn better returns. That creates a ripple effect. Other countries are forced to respond, raise their own rates, or risk losing capital, lower them and risk currency collapse. So even smaller economies are pulled into the same gravitational field. They don't fully control their own rates anymore. They're reacting to a global flow of money. Now, let's layer it all together. Central banks react to inflation. Markets react to risk. Global capital reacts to opportunity. And all three are constantly influencing each other. That's the invisible force. Not a single decision, but a loop, a feedback system. Here's where the stakes rise. Because small changes in interest rates don't stay small. A 1% increase might seem minor, but across mortgages, business loans, government debt, it multiplies. Suddenly, monthly payments jump. Companies delay expansion. Governments spend more just servicing debt. Economic activity slows. Now flip it. Rates drop, borrowing surges, asset prices rise, markets boom. But too much of that and you get bubbles. We've seen this before. Periods of low rates fueling massive borrowing, followed by sharp increases that break the system. It's a cycle. Expansion, pressure, correction. Over and over. Now, here's the uncomfortable part. Most people think interest rates are managed, controlled. But in reality, they're negotiated between policy, markets, and global money flows. And none of those are perfectly predictable. Central banks can try to guide the system. Markets can resist. Global events, wars, crises, shocks, can override everything. So the price of money becomes unstable. And when that price moves too fast, things break. Zoom out and you start to see it clearly. Interest rates aren't just numbers on a screen. They're signals. Signals of stress, signals of confidence, signals of imbalance. And right now, those signals are flashing more frequently. Debt levels are higher than ever. Global economies are more connected than ever, which means small shifts have bigger consequences.
So the next time interest rates rise or fall, it's not just a policy change. It's the result of an invisible negotiation between governments, investors, and the flow of global money. And the real question is, if no single force is fully in control, what happens when they all start pulling in different directions at once?